thank you very much for coming. I appreciate you coming into New York, and I'm sure all of our audience does as well. Maybe we'll just start with the elephant in the room, and that is the Fed. We were talking before we came out here about the Federal Reserve, where they might be headed, and as well as what they might do in the next cycle if the Federal Reserve does, in fact, start to cut interest rates at some point in the future, which is almost a given. So why don't I start with you? What is your view? What is the Franklin Templeton view, I suppose, on the Fed and their reaction function going forward, and where do you see the terminal floor?
So, I know that the market's pricing 2.25, 2.5. You mentioned 2.5 earlier as well. I actually think that's too low. From 1950 till the GFC, if you look at what the average real Fed funds rate was, it was around 2.5 to 2.5. That's real. If we are looking at a Fed terminal rate of 2.5, you are basically saying that real rates are going to drop to 50 basis points. This only happened in the post-GFC period when we had massive QT. We had the central banks which were buying reserves hand over fist, and we had very little productivity growth in those 15 years. Now let me take each of those. We've got QT now, not QE. We've got central banks which are not actually accumulating reserves as much as they are. And if we're to believe all the hype about AI, we're going to get a productivity boom. So why would real rates need to be 0.5%? I don't get it. So I think actually, more realistically, it should be around 4. Will it get to 4? Maybe not. But I think that neutral rate should actually at least capture 2% inflation and 1.5 to 2.5% real. So I don't believe it.
Andy, do you have a significantly different view?
Well, we think that in the next cycle, we're going to see a Fed that will become much more accommodative again. And as a reaction function to recession and the sort of rolling recessions, or definitely a softening in the economy. Let's just look at the 10-year right now. We're up around 375. Our view is that as inflation rolls down, we're going to see the 10-year drop down to around 3%. I am in the camp, though, that it's not likely to return to the QE years levels. We're not going to likely see 1.5% on the 10-year again, because frankly, we're in a reflationary world. And I think that's also going to put a floor on the terminal rate ultimately. But I'd be more in the camp of believing that 2.5% number, and I think that's what the Fed signaled, at least in their models and in their mind, collective mind, that's right. That's the right level. As I also think about the shape of the yield curve, after we come through a cycle, if we're going to literally see a 3% 10-year, then I think that it seems more likely that a more normally shaped, and even at 2.5, that would be a pretty flat yield curve. So I tend to think that's reasonable to see us return to maybe a long-term 2.5% target, which is, I think, what's, as I said, collectively in the Fed's mind.
So now, just to add to what Anne's been talking about there, bringing in the curve shape a little bit. So in an environment where you say have a 3% terminal floor, or somewhere around there, even if it's 3.5 or so, then what happens to the long end of the yield curve? Does that mean that the long end has to sell off from here a little bit to make a more normal steepness of the curve, or do you think just the yield curve is going to be perpetually a little bit flatter than it has been?
So I do think that the long end has to sell off, but I would note that, of course, the economy will slow. Like you said, it's inevitable. When it slows, I think the Fed can cut, to be clear, to around 2.5. I'm talking about when it renormalizes and in a non-recessionary, just a normal level of economic activity. I would anticipate Fed funds closer to 4. Now, if that is the case, the long end of the yield curve does need to sell off from where we are right now. And I think that's likely to happen. And so it is consistent with a slightly flatter yield curve, but not as flat as long end at 3 and short end at 4.
And let me start with you on this question. There's shifting dynamics between who is buying fixed income assets in the United States, right? It was back before the global financial crisis. There was a significant ramp up by foreign investors that slowed significantly over the last 6-7 years. Do you see any of these shifts in global fixed income demand dynamics changing, and how will that affect prices going forward?
Short answer is yes. There's a tremendous shift in who the buyer base is now. I mean, for example, we got really used to the Fed buying a whole lot of bonds as well, and of course we're likely to see, and we're predicting that the Treasury is going to have to issue $1 trillion of likely mostly T-bills here as we go through the rest of the year to inflate their balance sheet as well and reliquefy. And so as a result, we are going to see a different buyer base. But we have to think about the world as a circle, if you will, of transactional activity. And as long as we buy goods in dollars, we pay in dollars, their transacting partners around the globe are then forced to buy dollar assets and historically have bought those in our markets, of course. Now, there's some shift there in terms of currency trading. But nonetheless, those flows are going to continue. So we're not going to eliminate the foreign buyer by any stretch, but we're going to have to find other buyers. What does that lead us to? Well, that's a supply and demand problem. So at least in the short run, I anticipate that we are going to have some rate activity. The yield curve will remain inverted because all that Treasury issuance, particularly in T-bills, is going to have to clear the market, and the clearing level is going to be higher. So the yield curve inversion is going to continue because we are going to have to find investors in newer and different places. And we're going to have to do that by attracting them with higher yields.
So actually, it is a part of the same argument I'd use for the long end of the yield curve as well, precisely because those foreign balances are not as high as they were, and they do in fact, sovereign wealth funds. If we talk about FX reserves, I didn't know whether that chart was just FX reserves or included sovereign wealth funds, because a lot of the holdings have, of course, been diverted in emerging markets to all the different sovereign wealth funds. Those actors do buy longer end, and the extent to which you have the Fed not buying at the long end, you will at some point need to see a high, that pressure on the yield curve, I think, is both on the short end and the long end.
So let's shift a little bit, because you're the chief investment officers at your firms. Let's talk away a little bit from treasuries and into other fixed income asset classes. So now, is there a particular asset class that you would you think is attractive at this point, and that you look for overweighting maybe within your portfolios, or maybe it's the other way around, and something that or maybe a couple of sectors that you don't particularly care for and you might avoid?
So one of the things which we're doing is we actually remain relatively neutral on duration. We're not getting over our skis yet on duration or risk at this point. We think that time will come, but given what my views are on long end yields, I think that we are being patient. I think that if I look at the high yield market, I continue to see a little bit of cognitive dissonance between what the market anticipates based on the shape of the yield curve in terms of economic activity and the tightness of spreads in the high yield space, for example. Doesn't mean we don't find value. We do, but we're being very, very selective security by security there. Now, the other areas, so we do like shorter duration IG, for example. Within emerging markets, we think one of the most unloved pieces of the emerging market space would be in the frontier, the very high yielding EM, because they've all been tarred by genuine concerns about what debt restructurings will look like in a world where you have different investors, not just the private sector in the Paris Club, but you also have sovereign non-Paris Club. So I'd say that area, though, offers up value, right? It does offer up value, and EM local currency, especially in the rate side, we think offers value too.
Before I ask the same question to Anne, let me dig into that just a little bit. So you're cautious on the corporate sector, which, given maybe where equity valuations are and some other risk assets are, is there anything in particular that or any sector even within, broadly speaking, that you're concerned about, either from a valuation perspective, or if we go into a recession, is it a cyclical versus non-cyclical type of rotation that you think might occur within the spread sectors?
So actually, within the spread sectors, I think that it's not that we're looking at very specific sectors, because we find value practically across the board. The consumer, from our perspective, remains relatively strong, so it's not that we're discounting the consumer. I think the financials everyone's concerned that downward sloping yield curve is not a very attractive proposition. And we are waiting to see a significant sell-off in some of the regional banks, which just didn't happen. So, the concerns on that front were not met. But if we saw that happening on a case-by-case basis, we are hoping to find value over there.
And same to you, any sectors that you particularly like or dislike at the current valuations?
So while we're talking, shifting from rates to credit and other parts of the marketplace, what we have seen is we've seen a slowdown in issuance away from treasuries in the rates market. So at least in terms of the crowding out effect of treasuries, the good news is that there's likely to be, at least in the short run, a fairly good performance from credit. But because you don't want your fixed income manager to be an optimist, I tend to look very much forward into the risks in the marketplace, and it tends to be, one of much more caution. And particularly at this part of the cycle where we are seeing these very much indications of potential rolling recessions or slowdowns that are coming in one form or another. And so this lends itself to saying, are we getting properly rewarded for taking more risk into the portfolios? And our answer is no. And so we're taking a much more cautious view in our portfolio assemblage. And at this point in time, we're kind of avoiding the riskiest parts of the market. We are starting to see very significant idiosyncratic risk rising. So tail risk is definitely on the rise in our portfolio thought processes. And so we're avoiding the lowest rated credits, particularly those that are without covenant protection or creditor protection. And so it's going to be one, and like Sonal, we're really going to look credit to credit. And so up in credit generally, not just along ratings, so that even in the high yield space, though, we can find opportunities. The one good thing about this type of market where credit is being rationed and investors with capital to put to work can command covenant protection for a change, and investor protections are now coming back into the opportunity set. And so it's very much, security by security, and there are some really good places to find value. Structured credit is one, particularly the higher credit quality rated parts of that market. Private credit still offers opportunity, again, particularly because there's power in the hands of the creditor. Investment grade, simply because we're able to get income, which we weren't able to get 2 years ago. So you are getting compensated to be a little bit more cautious. And so that's really entering into our portfolio positioning thoughts.
So now let's talk a little bit about since you brought it up, the banking angst. So obviously a couple of months ago, we had a big issue with a couple of regional banks, and you didn't see, big systemic risks. I've suggested that perhaps if we were going to have another banking crisis, it would look a bit more like the savings and loan crisis than the global financial crisis, primarily because you were talking about different institutions. How much rationing of credit and a fear about rationing of credit going forward do you take into your analysis for where fixed income markets generally are going?
So, the rationing of credit, I've heard the estimates that credit rationing is the equivalent of 150 basis points of tightening, 200 basis points of tightening. I don't know where the numbers come from, because we certainly have not been able to put a number on the rationing. What I would say is, if we look at where the likely sources for issues might be, broad agreement, it's likely to come from commercial real estate. Commercial real estate is not a single beast. It varies from the type of real estate, the cities. It's so local. So we know that you can't just say credit tightening across the board. We don't expect that. I think this is one of the true wait and see moments. Effectively, the Fed gave us a 50 basis point rate cut already. Look, 2 days before SVB, Powell said that rates would likely go to 575, and we priced that. And then in the new SEPs, we went to 525. We got a 50 basis point rate cut right there, which meant that was their best fair value estimate of credit tightening. And ultimately, whether credit tightens because rates are higher or because demand is lower, same impact on the real economy. So, long way of saying, I'm not anticipating a massive credit crunch on the economy from here.
And are you worried about credit rationing and the knock-on effects from the SVB and Signature failures?
So I am a bit more concerned about this because what the Fed is ultimately doing through quantitative tightening is pulling liquidity out of the system. We've enjoyed 15 years approximately of being spoiled through QE and capital being available for any borrower at any time, and whether or not they deserved it, and hence the rise of the zombie companies. And what's going to happen now is that investors are going to be able to deploy capital in places where they are pretty well thinking they're going to get paid back and at higher returns than they had in prior years. And so that by itself is going to mean there are going to be winners and losers in the receipt of those funds. And you're absolutely right, Sonal, with regard to real estate. It's not a monolithic asset class. But even there, what's going to likely happen is that there could be some level of contagion among REITs or real estate investors because they themselves will find losses that they're going to have to cover. And we saw this, although I don't expect the scale of the financial crisis, so don't let anybody think that's what's going to enter into our thinking. But nonetheless, you can see these knock-on effects throughout the capital markets. And the more liquidity is removed from the system, the more likely this is going to become more problematic. That's why I go back to the statement, tail risk is rising, and then you start to see more idiosyncratic risk. So it's going to be very, very, you have to be a thoughtful investor in this cycle.
Obviously, some investors need to sell what you can, not what you want to, right?
Exactly.
That's ultimately the old adage.
I would actually agree with a lot, and I did not want to sound sanguine about the real estate sector or the financial sector. I just think that the immediate SVB follow-through, where serious people were talking about lines outside every regional bank, which of course would have been catastrophic development. I don't see that developing on the back of what we saw. Is there going to be financial market and asset price pain? 100% yes. How can there not be? We have, as Anne pointed out, 15 years of the Fed raising all boats. Well, that water's coming down now.
So let's talk a little bit about that. So how quickly does it come down? And are you worried about near term, long term? Obviously, you think longer term we're going to have higher rates than we've had the last decade, 15 years, which I think most people would hope for. But are you worried that we're going to fall into a recession, or do you think it's not particularly bad? How's things shape up over the next 6 to 9 months?
I think this again goes back to the last 15 years. A recession is not the end of the world. It's very problematic, but it's a recession of the style of the global financial crisis, which is devastating. A recession of a manufactured recession, such as the COVID crisis, which came about not for economic reasons, but other reasons. Those can be quite devastating, but then you have a variety of recessions. And I think the recession which we're going to see, given that we come into this with very healthy consumers, reasonably healthy corporates in terms of how they're covered, and indeed with increasingly better financial coverage in terms of covenants and so on. I think we will get a recession, but it might not be as dramatic and as sharp as the fear of the recession. Yeah. I'd say, a couple of quarters of reasonably broad-based. Remember, we start off with 3.7% unemployment.
And you'll get the last word.
Well, I don't disagree. I think that we will see slowdowns of a type, and they may be in various areas of the marketplace, most likely in secondary office or second-tier office. And so as a result, you're going to start to see these sort of slowdowns. But we've already been in this cycle. We saw manufacturing and inventories affected last year. We've seen cryptocurrency winter. We saw some tech sell-off last year, notwithstanding AI, this year. And so, this is likely to continue. But for the reasons cited, the consumer is in fairly good shape. And there's still a very large glut remaining of excess savings from fiscal stimulus and monetary stimulus that occurred post-pandemic. As that leaks out of the system and money supply continues to drive down, then we'll start to see the real impact. And that's when we should see these slowdowns get more magnified, but still not on the level of a pandemic or the global financial crisis.
Anne, Sonal, thank you very much. Appreciate your time and attention.
Thank you.
Thank you.